All right, this is the long promised educational video on how I draw actual real levels to use them for my support and resistance trading. So, first of all, I do not think there is any difference between support resistance and supply and demand. I think those can be used interchangeably. So, support is the same as the demand, and then resistance is the same as the supply. So, we do expect that once price comes to resistance slash supply zone, we do expect some kind of rejection and a downside move. Same with the demand or support zone. We do expect that once the price comes here, we are going to get some kind of a bounce and an upside move. First thing first, some people use lines for those. Some people use zones, sort of boxes. I do prefer to start with a higher time frame. So in this case, weekly, and we're analyzing the S&P 500 futures. First thing first is I start with a weekly time frame and I map out the weekly zones of support and resistance. Those are mapped in blue in this case, and it's just easier always to start with a higher time frame. I would recommend for you to start with at least two time frames higher than the time frame you were planning and analyzing your trades on. So for example, me, I'm always planning and analyzing trades on the hourly, so I use the daily and the weekly, which are the two higher time frames for my levels. The gray zones, the gray boxes, are the daily time frame levels, and then the blue boxes, blue zones, are the weekly time frame levels, and those are very crucial. They're critical because they are much more reliable. They do produce better bounces. They do produce better upside downside moves. They're more reliable. So once you map them out on a weekly, drop down to the next one. In this case, it's going to be daily. So obviously, if you're not like me, if you're not trading on the hourly, if you're looking at the trades on the 15 minutes or like 5 minutes or even lower 3 minutes, so on and so forth. For the 15 minutes, maybe don't have to go all the way to weekly. Maybe your higher time frame is going to be just the daily levels, and you should be always aware of them. In my opinion, I will touch upon that in later videos. But for now, once we're down to daily time frame, do the same thing. Just look at where the price was rejected from swiftly and map those places as zones, and then where the price would bounce, where the price would bounce, you would map that out as a level as well. So any rejections or bounces, you quickly map them out as your levels, and then the next level after that would be the hourly. In my case, hourly levels, just because I trade on the hourly, I look at the trades on the hourly, I analyze on the hourly. Obviously it's going to be different for you. In this case, we have a support level right here for the hourly, because we are at the lowest time frame. For me, I do use lines instead of zones, but the reason why I was using zones before for higher time frames, it just is better once you are back down on low time frames, because right now, if you were at this point here, you can see that we have managed to hold the blue weekly zone, and we were higher than that, so we definitely gained it. Gaining a level means that you managed to get above it and kind of get some kind of meaningful closes above the level. And once you do return back to that level, you do know that you're expecting some kind of a reaction of it. Obviously, because it's a weekly level, it's going to take much longer for it to produce some kind of a meaningful bounce. But then once you do reach the hourly level, you can see that it's going to work in a matter of hours, literally just a couple of hours, just even 1 hour, and it bounces, then comes back, bounces again, just hourly candles. But with weekly levels, you might have to wait all the way So here, for example, we touched upon it on Wednesday, January 7th, and you only managed to get a meaningful bounce around Thursday, so the next day. So it could take a day or so just because it's a higher time frame level. But the beauty of using them as boxes, as zones, and then dropping down to lower time frame and then mapping out your lower time frame levels is that you do know that you're going to get a bounce from here just because it's a support and it's a just because it's support and it's gonna work that way most of the time. I'm gonna explain later how you're gonna know if it's a weak support, if it's a strong support, but just because you know it's gonna produce some kind of a bounce and you're gonna try to buy here, you're gonna try to long. It also helps if you're aware of the higher time frame context, and in this case you can perfectly see that you're coming above to the blue weekly zone, and you do know that it's going to produce eventually a bounce, and you're also expecting bounce from the hourly level. So in this case you have some kind of confluence from both levels, and it just gives you more certainty, more confidence, and it's a higher probability trade when you have that. So, but if you're trading on the hourly and you're not mapping out the hourly levels, what's gonna happen is that you use the wider box, the wider zone for the weekly, and then once it comes here, you do know you have to long because you're expecting a reaction, but you don't know how long. It's not as precise, and you're eating a lot of price movement here against you. But by just mapping out this level, you do know that here you need to look for longs once we cross this, and then your entry would be here at the hourly level. So this is a little sort of my method. Probably some other traders are using it, but I always use that. I try to take trades on hourly levels, but I do like to have some kind of a daily time frame level or a weekly time frame level supporting my idea. Now, you do know that once you're between the levels, you are expected to see some kind of a ping pong kind of action where the price goes down and up and down, up and down between the levels until it resolves to either further downside, so downtrend, or it would go up and then break the level. And the main question with traders is, I feel like a lot of people are very good at mapping out the levels, right? You see this is a good hourly level just because you saw the price rally into here and then reject, so you would map that out, and then you would use sorry, not being very accurate, but you use this for a little hourly trade, so on and so forth. So the main problem is not with mapping out levels. I feel like the main problem is how to differentiate if the level is weak or strong. And what I mean by that, if your support level is strong, right, you will most likely get a nice bounce from it. But if it's weak, it is likely to break down. So how do you know if it's weak or strong? Well, it's very easy. First thing first is I looked at number one. Let's write it out for the video as well. Factor number one would be distance. So what do I mean by distance? I mean how far it travels from that level. So it comes in here, right? It's a daily support zone. How far up does it travel from it? Does it just travel sort of, let's imagine the price is coming here, right? Does it travel a little bit up, doesn't reach any other levels above it, any other meaningful high time levels above, and then goes down, so it didn't manage to travel a lot? Well, that would be a negative, right? We want a level that produces strong bounces that go up, and cover distance. So sort of more distance covered by a bounce and I'm gonna call this stronger level factors. So more distance is covered by a bounce, the higher it goes, the stronger is the level. Second would be speed. And what I mean by that is, first thing is that how quickly does it bounce? Does it bounce slowly? Is it grinding? Or is it one swift hourly candle? That's very important, because usually if it's grinding from it, if it's doing it very slow, that's a minus. That means it's a weaker level. You really want it to be speed. Faster it moves away, the better, right? And then third one is, oh, and also one thing I forgot, it also matters in this case with the speed, it matters on the nature in which it comes to the level. So if it's just grinding slowly to it, I am less likely to take that trade to go the opposite direction, to use that support level and buy and long from it and try to catch the upside move, just because I've noticed in my experience, when the price is slowly coming to the level, you usually do not get good bounce. You do get good bounces when the price comes in one swift motion. Even if the level is eventually going to fall, like so, you will get this small bounce, so you will capture some kind of a move. But most of the time, if the price just grinds and gets to your level, you don't get a bounce, or maybe you just break it down. So usually if the price is very slow, it means that the level is slow, the level is weak. Same with if the nature in which the price leaves the level. If it leaves the level in a slow fashion, that means it's a weaker level. And then the third factor is time / number of touches. And what I mean by that, let's see. If the price comes here once, touches the level and bounces, you got your first touch. We just saw that the level is there, that it's strong, there is a bounce, it's probably gonna bounce in the future again. Then the price does whatever, comes back again, bounces again. That's a second touch. Now you know that this is definitely a level, but you also wary that it's already been tested once and then twice. So it's already been tested twice. So when it comes here third time, usually it means that the level is getting weaker, because the price wants to test it again and see if there are actual buyers here who are going to step in and drive the price up. But just because it's coming back here, eventually the buyers, they're going to run out of sort of ammo, so to say. But you could think that the buyers would be exhausted, they wouldn't be able to support the price, and it eventually it will eventually break the level and go lower. So starting with touch number 3 and then going, I've seen as many as 5 so far. Starting with touch number 3, I would be wary. I would consider the level getting weak, and there would be a potential for a breakdown. And then in one of my daily market reviews, I was analyzing the level that was about to break down, and I said that a touch number 5 is a guaranteed breakdown of the level, of the support level. Just because it's been tested so many times, it's likely to just break. Same with resistance, right? If we're touching it so many times from below, it's eventually gonna break and we're gonna break out. And number of touches essentially means the amount of time we spent, right? Because we spent more time if we came there, but also if you were spending a lot of time at the level, right? Let's say this is the level. You're spending a lot of time before bouncing. That's also not good. You are essentially what's happening is that the buyers that are buying here, that are propping the price up, they're getting tired. So the more time, or the higher the number of touches that the level gets, the weaker is the level. So I'm gonna write, we need less time and we need lower number of touches to that level. So these are the factors that I'm looking at when I'm analyzing the support and resistance levels, and I'm trying to determine if they're weak or if they're strong. If they're weak, then I'm less likely to take the trade because I do not want to take unnecessary risk. There is enough risk in trading itself. And then if it's strong, then I have more confidence in my setup and I'm more likely to take that trade. Now, some people do certain color schemes, like let's say you're here, you're in this moment right here. Some people go ahead and just map the resistance, the supply, they would just make it red, and then the demand, the support, they would make it green. I don't really care for that. If it helps you psychologically that you're supposed to buy and long from the support and you're supposed to short, you're supposed to sell at resistance, and that's why you map it, you color it red, go for it, go ahead. But I personally don't find much benefit to that. I do know some people are they are sort of impacted by that a bit. And then one more thing I wanted to touch upon is that you really need to look at the levels as a game of ping pong. So you're playing ping pong, up and down, up and down. The price is going up and down. Obviously, if you are a reversal trader like me, a range trader, if you are, but even honestly, even if you were a breakout trader, you're playing the ping pong until the price does a breakout, and that's where you get long and you go with it. Or same with if it breaks down, you would go down, you would short. So just look at it as a game. I think it helps a lot and it relieves the pressure. One thing I want to notice is that this does not work 100% of the time. So just because you know the stronger level factors you use, the distance, the speed, the time, number of touches, does not mean that you're gonna have 100% win rate. Anything above 50% win rate, I think is pretty good. So you need to be a little bit realistic. You do earn money by using proper risk to reward, and then risk management and psychology, not by having 100% win rates. I don't know any people who would have 100% win rate. I don't think it's achievable, so you shouldn't strive for it. Obviously try to make your win rate at least 50% or higher through polishing your strategy, through making it better. But do not just always rely and think, oh, we're coming to the support level, I'm gonna put the entire deposit all the money I have and just long and buy from here with 100% going up. Like, always take into account that you could be wrong and this would not work. Most of the time it does work, but there are times where it doesn't, and if it just goes down, you would lose everything unless you're using proper risk management. Proper risk management would mean that you would see at this point right here, let me just go back. At this point right here, you would understand that we lost the level and you were wrong, and you close the position, you cut it right here, and then you minimize your losses and you survive and get to live another day and keep on trading. So that's very important. Let me think. I think I've touched upon everything I wanted. I'll try to find actual real world examples for analyzing the stronger level factors, but for now I just want to get this video out there and just sort of share this with you, how I draw, how I differentiate between weak levels, between strong levels, how I look at the market. And yeah, thank you very much for watching this video. There is more to come. I will tune in tomorrow around 5 a.m. Pacific with a daily market review, and we'll take it from there.